Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome, Art Jarvis. I'm going to say, this is Chuck Gibson. Taking Stock, episode 51 with Art Jarvis. So welcome, Art.
As always, happy to be here.
And how are you?
I am fantastic. Thanks for asking.
It's good to hear. But you're even better than fantastic. I know because we always chat a little bit. But you're just coming off of the. We are both. It's Tuesday, the day after Memorial Day. Mm-hmm. You're coming off of a nice extended weekend. Yeah. Markets were closed yesterday. You didn't have to worry about any of that.
Right. Yeah. Try not to worry about it anyway. But you're right. 3 days. 3 days basically in the woods. The weather was absolutely perfect.
Oh man!
Got to relax. Got to play some games, read a little bit. It was a good weekend. So. But yeah, and then today's a good day too. So
I'm extending my weekend. People can't see it, but I'm just like kicking back right now, hands on my head, legs stretched out. All I have to do is listen to you share and take stock. But anyway, you said something good today too.
I think I mentioned to you, I come today bearing glad tidings. So
well, thank you.
That's right. We talked. Well, there's a lot of good things that happened. I'm not going to get my days right, but we had another streak. I think it was 6 days straight in a row of positive gains. So I think I might not get this exactly right, but I think we had 7 straight days of positive gains. We took a short breather, and then we had 6 straight days of gains or something along those lines. So We've gone from, as we sat down here to do this show, the S&P 500 hit 5,900. So
nice.
So we were at 4,800 7 weeks ago. So we've gone from we've added 1,100 points to the S&P 500 in 7 weeks.
And I hate to repeat it, but it seems like I have repeated it because it's mind-boggling. We dropped, S&P 500 dropped from that high of 6,200,
right,
all the way to 4,800,
4,850, right around there.
But still,
it's a huge move down, and we've talked this ad nauseum about how ridiculous that whole thing was. And
you got to use your word, that ridiculousness.
And then here we are, we're basically 300 points away from the top that we hit on February 17th, maybe middle of February. We get worked up about last week, one of the down days, we were all worked up because of the interest rates. The 10-year Treasury worked its way up above 4.5%. Okay, well, we've been hanging around 4.25%, 4.33%, 4.35%. So. That's a 15 basis point or 25 basis point move. Who cares? It's 4.5. Okay, we hit 4.5%, and I do acknowledge, you don't want interest rates to move too much because that messes with your calculations on what you think the future level is going to be. And then the truth is, let's just say $300 in S&P 500 earnings for 2025. One market multiple. So if we go from a 20 market multiple down to a 19, that's 300 points right there. So
wow.
It's a lot harder to make up those market multiples than it is you have to move a whole lot of earnings in order to make that up. So,
right.
But maybe who cares is kind of a strong way of putting it. But we went from 4.3% to 4.5%. It's not in the direction you wanted to see it going, but it's not, in my opinion, at that level, it's not a difference maker. Okay, it's not going to change the way I look at things. You know, if all of a sudden we jump to 5.5%, guess what? You got my attention. Right?
There you have it. Yeah.
So yeah.
I was going to say there are markers there that you say, okay, wait a minute, and it's like you just said. Now you have my attention, but that was not. That's like, hey, yeah. And again, I love that. I'm glad you said. Maybe that's a little strong. People out there don't really want to hear the financial advisor like, who cares? Well, you do care, but it's like in the grand scheme of things, it's an insignificant marker at that point.
Yeah, it's not going to send me running out the front door screaming with my hands up in the air and everything. You know, the sky's falling. The sky. It's not. I mean, don't get me wrong.
Well, see, you're much more composed than I am because I'm running out the front door screaming with my hands in the air over the smallest little things.
Yeah, but in your neighborhood, that's just a normal thing, right? I mean, it's so. I mean, interest rates moving up. So if interest rates move up, does it change the calculation? Yes. The point is does it change it meaningfully? Yeah. So it's no. You know. So the answer is no. It doesn't. Right. So and then the other nice thing is you know, we got, I think at the end of the episode a couple weeks ago, we brought up I'm waiting with great interest to see the consumer sentiment and consumer confidence numbers.
This is what I'm waiting for right now. Ready? Go.
You want to hear it?
Yes, I do.
So this morning, 10 o'clock this morning, they report the consumer confidence number. Not only was it good, it was way better than expected. So, you know, and why is it better than expected? Because everybody calmed down in regards to the tariffs and things like that. You got good news from the UK, you got good news from China. You know, we don't have a deal yet, but they're talking. Okay, and this is what we talked about. You're starting to take a little bit of uncertainty off the table. You take a little uncertainty off the table, people start to calm down just a little bit. So we got a real good consumer confidence number. So guess what? The consumer's still in it to win it, right?
Yeah.
And
what was it? What was the number again? You said they had an expectation of a certain number, and they were far better than that.
Yeah. So it's not a percentage number; it's an index number. So they were looking for an 86 was the number they were looking for, and it came in at 98. Yeah. So that's you know, again, it's one number, and I'm not going to get away from what I preach that I want to know the trends, right? But yet. That's not a signal that we're losing the consumer, right? And then you couple that with the fact that, you know, there's some numbers that came out in regards to credit cards and things like that, and debt load and debt spending and things like that. You know, the one thing that was interesting is really the debt numbers on like the credit cards and everything are just now getting back to the level they were at pre-pandemic. Okay, now. Potential debt, you know, available debt is definitely a higher number, and basically that number generally trends upward.
Okay. Art, you know from the number, and this is Taking Stock episode 51. We are 2 weeks away from 2 years of this, so you know in those 2 years that I frequently asked the question about, especially credit card debt.
Yep.
So you know that's like a concerning number for me. And again, that's where, you know, like you're a little more composed. You understand it better than I do. I'm running out the front door screaming and saying, everybody's debt's too high. Or my own. You know, thankfully that's not an issue at my house. But so bring that down. You know, when you say the credit card numbers are just now getting back to pre-pandemic. You know, why is that a good thing, or why is that a bad thing, or what is that thing? Well, how would you describe it?
I guess I would neutral to not good. I guess is how I would. I mean, the fact of the matter is, you know, we spent a few years anyway spending $6 or $7 trillion that got pumped into the economy, right? So I think that tells me now that we're starting to go back into debt again. Okay, as a whole. Now, but we're just now getting back to where we were 5 years ago. So it's not like we've gone crazy or anything like that. And that is on top, you know, the level is also on a much higher level of potential debt. So if you look at the percentage of debt being utilized to the potential debt, that number is still a lower number than what it was 5 years ago. So it's credit card debt starting to climb. I just categorize that as not necessarily a good thing, but right now it's not a terrible thing either.
It's like put a watch on that.
Yeah,
but don't panic.
Yeah, precisely. This isn't. It's not 2008. If you look back at 2008 from a debt standpoint, we were in a bad place, right? And then that's why we spent 15 months adjusting where we were, right? And unfortunately, as I like to keep pointing out, we as humans, we just keep making the same mistakes over and over and over again. We have very short-term memories, and it's just a fact. It's just a fact of the matter. So,
well, you're the expert, on this show, and I'm not. But I was just going to tell you and say, well, you're cutting into my comment, because it's like when you say, we keep doing the same thing over and over again. And I was just going to say, so credit card debt, not good. Put a watch on it. But it's like, put a watch on your credit card debt. That's the message every day for all of us. Is there any financial advisor that would say, increase your credit card debt? No, they're not. They're saying, hey, keep an eye on that. Pay off your credit card.
If you've got a 5% credit card, go ahead. But you don't have a 5%.
Because your investments are going to outgain the 5%, right?
If you have a 25% credit card, no, you're not. You don't want to. You want to work very hard to get that debt level down if you have one at all. You're right. So
the borrowing factor in anybody's personal finances is an important piece. But and I say borrowing, but that's the same word as debt. Yeah. The debt factor you have. Yeah. Is a very important piece of whatever the puzzle, and it's obviously likewise a very important piece of our national economy or global economy.
Yeah, really global. And again, I have this conversation with people pretty frequently, but it's being in debt from especially on credit cards and things like that. If you've got a 25%, 20 or 25% credit card. It's I guess that you're in a spiral that is very hard to get out of, right? So if you've got a lot of debt and it's in credit cards and things like that, number one, that messes with your credit score. Well, guess what? If you go buy something, if you go buy a house, you go buy a car, go buy appliances or something like that, they don't give you the top tier premium interest rate if you want to finance those kind of things, right? So not only now do you have high credit card debt, but if you go buy a car, you don't even get the same interest rate as maybe someone who has a 700 or 800 score. So it's just piling on. So that's why, I say it all the time, I most certainly understand how if you get into a bad situation, it takes time and dedication to get yourself out of that situation. Yeah. It really does. So yeah, it's very important. And, this is things you talk about, going into the high schools and stuff and talk to the students. This is stuff that it's important. If they can remember that one lesson coming out, they'll save themselves a lot of pain and a lot of trials. So
how do you? And that's a great point. I mean, the education aspect for our youth, and many times on many of these shows, as we're coming up on 2 years, we pointed directly at talking to the younger people about investing and being smart now. But how do you learning is kind of like a hands-on thing, more so. You can't just stand there and speak it. How do you put the that lesson into something that they can feel or see to understand, as opposed to Art Jarvis goes into a high school and talks about you don't want to increase credit, you don't want to build credit card debt, or you don't want to build debt because it piles on, like you said. How do you make that something that they can feel and touch?
That's a good question. I'm not sure I've actually achieved that yet, but I mean, you make it. I mean, you start off trying to make it pertinent to their situation, right? you're talking to a 16-year-old in high school. Hopefully they don't have credit card debt, right? They might have their first job, at 16 or something like that. So yeah, it's hard. And then, you start talking to them about retirement, and they're 15 years old. You're talking to them about something 45, 50 years from now. Right. So, you got it. But, I think for me, I just kind of, honestly, I started throwing some big numbers at them, hey, if you do $100 a month for the next 40 years, you can easily have $600,000-$700,000 saved up for retirement, Right. And that doesn't even include 401ks and the matching from employers. So,
and the compounding interest or whatever. Yeah.
The eighth wonder of the world, compound interest. So, you're right. I think, you go and talk to a bunch of 15, 16, 17, 18-year-olds. Yeah, it's, I can stand up there and I admit I can see their eyes starting to glaze over and things. But, you just kind of, as with a lot of things, hopefully you say something and you planted a little seed.
Right.
And maybe you didn't think they were listening, but, maybe somewhere down the line they're about to make a decision and they remember someone. It was 5-10 years ago that I think in Ohio, put in the whole financial literacy courses into the schools, which brilliant. How do you write a check? What's a credit score? What are credit cards? What's that mean? How do you invest? What's
real
a stock?
life.
Yeah, what's a stock? What's a bond? All those kind of real life things. So.
Real life skills. Well, as we're sitting here and I'm thinking of how difficult. That's why I asked the question. I can only imagine. That's not like you can put it in their hands. Mm-hmm. But, although you could bring a pile of money and show them how it dissipates or what.
Monopoly money.
But as you're talking about it, I was like, maybe, when you said I throw big numbers at them. Yeah. So that's to encourage, hey, this is, if you start putting $100, we'll say a month, a week would be better. But, you start putting that away, then, as you said, you could easily have $600,000-$700,000 in retirement at a certain point, and without even talking about 401ks or anything. That's just that kind of savings thing. To turn it around and make them understand the debt part and how do you make that real? I was thinking about this. So tell me if I'm right. You could say, so you're putting the $100 away, but you're also using your credit card, and it has an interest rate, so you're paying back. You borrowed $100. Now you put $100 in your investment, and that's good, and it's going to do whatever. But you took that $100 in a credit card debt, and you didn't pay the credit card off to zero, so now the interest rate. So from that $100 that you thought you put away, they just took $50, or whatever. So now, so this $100 went to $50, and it's like you're killing yourself.
Right.
I mean, I don't know. Does that make sense?
Yeah, it makes
perfect
sense.
Give that example, and again, it's still words, but
but the problem is like I'll get someone has a baby, right?
Someone
and
does.
The first thing people want to do to have a baby, they want to open up an education account or some kind of account where they want to save money for the next 18 years for their kid, and depending on what they want to do when they graduate from high school, there's some money for the child, right?
Right.
But here's the problem: if you come to me and say, "Hey, I want to put away $50 or $100 a month to sock away for little Johnny," that's great. But if you got $10,000 in credit card debt sitting over here at 25% interest, guess what? You need to take that extra $100 a month and put it on the credit card because you can't compete. Now, even if you end up making, on average, 10% per year, and you got a 25% credit card, you're 15% behind the game, right?
That's it. That's the lesson.
That's it right there. And it's you just, but unfortunately, you just run. Some people are just really, really bad with financial decisions, right? And it's very hard to, you just get, the car breaks down. Okay, well, where are you going to get the money for the car to fix the car? Well, some people don't have a whole lot of options, right? Or maybe they go dipping into their 401ks or something like that just to fix the car. Well, you got to do what you got to do. I most certainly understand that, but that can be a very expensive way to fix your car or fix your whatever you got to fix, and it makes it real. Once again, it's I just look at it like this spiral that you're in, and it's very hard to climb out of that spiral. It takes the Great Recession we talked about in 2008. Not only were one person in the household losing their job, there was two people in the household losing their job. And all of a sudden they've got a financial crisis, right? They've got two cars and a house payment and maybe some credit card debt and stuff like that, and the income just stopped coming in. Okay, so once again, in order to avoid bankruptcy, it becomes a longer term process. And it takes dedication. You have to stick to the budget, right? All those extras. You don't go to Starbucks and get a whatever a coffee costs at Starbucks. I know an iced tea costs $4.50, so you don't go get a $4.50 iced tea at Starbucks every single day. If both of you don't have your job and you have all kinds of debt, right? I mean, it sounds it sounds funny, but we get into habits and there's things we like to do.
Come on.
And so again, I feel like I'm up on my soapbox a little bit.
I need my Grater's ice cream.
Well, yeah, don't we all? But I mean,
well, I'm just trying to think of all these things you put hands on. It's really you have to hit that spot that brings it home to whomever you're speaking, and it could be adults or it could be the kids at the high school. We're focused a little bit right now on the kids at high school and trying to teach them the good money habits, the investing habits, the saving habits, the growing your money habits that'll help them avoid that spiral. Because both of us sitting here know that something can happen and you have to do what you have to do. And that, it is what it is at that point.
Sure.
But trying to develop those habits, and we're talking to the kids, and, I'm all sports all the time, and of course, first and foremost, baseball. So it's like, I'm thinking, we scored 3. Yeah, but they scored 5.
Right.
You're down 2.
You're still down.
Football. I mean, lacrosse. I swam the fastest lap of my life. Well, guess what? It was still slower than the person you were racing, and you're second place. I drove. We talk here. You and I both know, but certainly on Loveland Beacon, we hear a lot about the kid here in Loveland, Evagoras Papasavas. Well, he ran the fastest lap of his life, but guess what? 15 cars ran faster than he did. That's not first place that day, whatever it is. And vice versa, but I'm like, you got to bring it home. Yeah. So, I mean, I'm just trying to help you, Art. The next time you go into the high school and talk, how do you reach the kids, And I think you've probably done it enough.
I'll just bring a stack of money or...
I think
about gold chocolate coins or something. How's that sound? But
you're choking me.
It's the same conversation with the kids as I have with the adults. There's a very well known financial guy out there that gives advice on budgeting and things like that, and I generally agree with this. This person says mostly 90% of the way, but then he starts preaching that you want to pay off your house and you want to pay off your cars and stuff like that. I will argue with him to the grave that if I have a 3% loan on my house and I'm making 10% on my investments, guess what? I'm going to try to never pay that loan off. If you say I'll give you some money at 3%, guess what? I'm going to ask you how much will you give me, because I will take it all at 3%, right? And it's the same thing. It's the same, and even cars, which of course is a depreciating asset. But guess what? If I can get a car for 1.99% and I can make 10% on my investments, I'm going to finance the car. As much as maybe I hate to make a payment every single month, I'm still going to do it because I know I'm 8% ahead of the game.
Well, and again, it's the same. It's the same lesson. It's a lesson. It's the same message, and it's Chuck still talking about baseball. Hey, you can have 3 runs. We got 5.
Yeah, right.
I'm good. I don't care if my pitching staff gives up 3 runs a game for 162 games a year if I know we're scoring 5. That's kind of what you just said.
Yeah.
I'll borrow at 3% all day long while I'm putting this other money into investments that are earning me 10% return. Because I'm plus 7, baby.
Yeah.
You know.
Yeah, and I still fully believe that the market will give you positive returns in general 4 out of every 5 years.
Yeah.
Okay, so generally 75 to 80% of the time the market's going up. 20 to 25% of the time you lose a little bit, right?
Sure.
Well, guess what? But I also still know that in spite of all those. In spite of all those bad years or bad things that have happened in the last 40 years, we have still made 10.14% per year for the last almost 40 years, on average. Now, there's been great years and there's been not so great years, right? But guess what? Still making 10%. The trick is don't lose 55% of your money right before you want to retire, right? So that's
I was going to say the trick is to not have that losing streak right before you start using it. You got about 2 minutes.
Oh.
Maybe less, but anyway, I'm going to say we got 2 minutes. So you came bearing glad tidings. Thank you very much. Glad tidings with good news of consumer confidence report came back better than expected. Mm-hmm. You said 98 compared to the 86 that they were looking for.
Yeah.
Just kind of recapping a little bit of today. And then we just spent, about 10 minutes talking about how do we tell, and forget about kids. We really did focus on the youth. Mm-hmm. But how do we tell potential investors? How does Art Jarvis and Jarvis Global Investments speak to the people, bring it home so that they can understand the best way to have their money earned for them and keep them from going into a negative spiral? And how do we do that for the marketplace? Last question, wrap it up.
How do you do that for the marketplace?
Well, for the global economy. What's that?
Well, what holds true in your household also should hold true in the world. It's like if you can't afford it, don't buy it. Okay, so depending again on how you can finance it and things like that. But I guess I've never really been a person that needed instant gratification, right? I didn't have to have the best stereo. I didn't have to have the best golf clubs. I didn't have, it's just,
all the toys.
All the toys, it's, if things came around and it was doable, then fine. But I also knew if I went out and bought those golf clubs, I should be able to pay the credit card off at the end of the month too, right? So, it's a good way to live your life. Now, I'm not, nobody's perfect. Nothing happens as easily as you want it to happen, right? Sometimes you have an emergency. If your washer and dryer your car goes out. That's a great example. Your car goes out, you got to put that on the credit card, and you are not able to pay that off at the end of the month. Fine, but hopefully you can pay it off in a couple, 3 months or something like that. Because if you don't have your car, now you got trouble getting to work, right?
And then you don't have your job.
Yeah.
It's that spiral that you talk about.
Precisely. So it's like I got to fix my car. It's like, man, this is This is a very expensive way to fix it. I'll use like an IRA or something there's for smaller companies what's called a simple IRA. And sometimes people will say, I got to take money out of my simple IRA. Well, that's exceptionally expensive because number one, you're going to pay taxes on it.
Yeah.
Number two, especially if a simple IRA hasn't been around for at least 2 years, you pay a 25% penalty on that. So let's just say you're in the 20% tax bracket. Now you got a 25% penalty. Now you're at 45%. Let's just throw 5% in for the state of Ohio. Now you're at 50%.
Yeah.
So you just financed the fixing of your car with 50% money.
Ooh.
I tell people, go find a loved one. Go find someone and pay them 10%. That's way better than 50, right? So, it's just, I guess it's just a way of living your life. And, I can sit here and preach all I want, but it's just
not today.
But I say not today. But I'll say it one more time. If you are able to, and I don't care if you put away $10 a week. Do it.
Yeah.
Don't touch it. Be consistent about it, and in the long run, you'd be very surprised. In your 20s, it's exceptionally boring. In your 30s, it's not a whole lot better. 40s, the numbers start to look a little more impressive. 50, you're really liking the numbers, right?
Sure.
And then right somewhere between the 50s and 60s when you retire, you should get one more doubling, and it's that one more doubling that puts you where you want to be. Everyone says, "Oh, I'm never going to retire." So yeah, you got one more double. You got 7 more years. One more double is going to happen. So that, whatever that number is, that $250,000 you have is now $500,000. Yes. Guess what? All of a sudden you're there. And one other comment. You don't necessarily need $2 million to retire, right?
Yeah.
I mean, some people do because they have credit card debt and they got a mortgage on their house and they got 2 Mercedes sitting in the driveway. And so yeah, they might need a couple $1 million to retire on. But I also have a client who retired on $250,000 and she's living her best life. So
amen.
There you go.
Well, Art Jarvis, that brings us to the end of Taking Stock, episode number 51, and just puts us on track, aims us straight ahead to 52, which will be our 2 years of taking stock. So hopefully the next 2 weeks will bring us once again glad tidings from Art Jarvis and the investment world.
Yeah.
So
wouldn't that be something if we hit 6,200 on the S&P for the 52nd episode?
Well, if it does that, that'll be very exciting. The next 14 days
Yeah,
to get
I
from
think that's asking too much.
59 to 62
in
the next 14 days.
So what is that? About 6%.
And I don't think that's what's going to happen to you, but you are going to celebrate a birthday. So happy birthday between now and the next show.
Yeah.
Yeah, because the next show we decided is like June 9th.
Yeah, that's right.
We don't have to tell everybody the date of your birthday unless you want to.
But
anyway, well, from Loveland, Beacon, and Chuck Gibson and all the listeners here on Taking Stock, happy birthday, Art Jarvis. Thank you.
Thank you. Appreciate you and appreciate the birthday wishes. Thank you.
Well, that's it for Taking Stock 51, and we will see you, listen to you, hear you again in 2 weeks. Thank you so much.
All right, thank you.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.